G'day there everybody, thanks a lot for joining me in this weekend market update. The last time I left you a video was actually as at the close on Tuesday afternoon. I also recorded a video as at the close of business on Monday. Both of those videos were talking about, again, the continuation of this sell-off, or what has been that of a sell-off back down into this intermediate trend line. And it appeared as though, as at the close on Tuesday, that we were beginning to establish again, or once again in a continuation of pillars, that next subsequent higher low. That higher low, of course, is relevant as to where we have been back in the month of December 2018, also through to the period, almost the midway mark of 2019 anyway, very early on in the period of June. And here we are once again in the month of August, retesting that intermediate trend line. And as you can see, again, fast forward another 3 trading sessions. This is Wednesday's candlestick. This is what we call an outside day engulfing candle. Thursday, we had a tremendously strong session. Again, another short squeeze to the upside. We closed this open window. This window was the difference between the closing price on Wednesday last week and then, of course, Monday, the week just gone. A big gap to the downside. So again, that was closed on Thursday. The handbrake was pulled on Friday. But when you think about it, and when I flick on over into that of a weekly candlestick chart, you can see that we are left with that of a white real body candlestick. Now, the NASDAQ itself, it is sort of the odd candlestick out. When I change on over into the Dow Jones Industrial Average, this candlestick is very significant. It's what we call that of a hammer candlestick right on this intermediate trend line. It is a very bullish signal on a weekly time frame. And also when we jump on over into the S&P 500, again, this is the chart on a weekly time frame. We have a very similar type of pattern. Not a textbook hammer candlestick, but you can see definitively this long lower wick. Now that lower wick was, of course, the reversal which took place between really the gap down on Monday and then the strengthening of the markets off from this critical area of support. I'll be the first person to put my hand up and say, look, the markets didn't stop in this green rectangular box. Ideally, this was the general vicinity whereby we thought this market sell-off would stop. It actually overshot it. But what is really important to note, and this is really the message that I tried to leave you with on Monday and Tuesday, is that, again, a trend is assumed to be in effect until it gives us definitive signals that it has reversed. So as dire and as dicey as what it was looking at on Monday, again, there was a resilience of buyers to jump back on into the markets collectively across the 3 closely followed US markets. And as such, we actually closed quite positively on a weekly time frame. Now, again, you have to expect markets sort of volatility and uncertainty to persist. It's quite interesting again because I've just finished this weekend's analysis class whereby we've recapped the 3 US markets. We've also included 2 additional pieces of fundamental data when it comes to, people always ask me about where we fit in the current market cycle. And also I always get sort of this trickle of commentary when it comes to just comments really below these public YouTube videos. People tend to disagree and say that the fundamentals are horrible. And I don't ask the questions, but I often ask, well, where are you getting your data from and what essentially are you reading? Because the things that we look at, which are historically most accurate, still give us, all right, or lend us to believe that mixed with the technical picture, that you should be still very much so optimistic, not only for the year 2019 for the second half, but also this will continue most likely into 2020, and also probably beyond into 2021. That will probably be the end at the absolute 2021. It may happen very early on in 2021, but as it stands, 2019 is looking very good. That's all we really necessarily need to see at this particular point. The good news about technical analysis and being as active as what we are when it comes to technically swing trading the financial markets is that our forecasts, they don't necessarily need to be correct on a 2-year time frame, but what they do need to be correct on is on a multi-month time frame. Okay, we need to get that right, and that is exactly what we continue to do. All right, very humbly, I can sit here and say that most of our analysis, the public and also private analysis, is pretty close to the mark. All right, it's never going to be perfect. Never will say that the analysis is going to be perfect. You often hear me talk about the blending of the art and the science when it comes to technical analysis. And it is, pardon me, really just a process of drawing together different components of analysis to come together and to really give you a good understanding of just simply what's happening below the surface. And as such, pretty much as it stands as at the close on Friday, once again, for those who have positioned themselves and have sort of stood up to the plate with a little bit of courage and conviction, for those who've actually bought, not necessarily on Monday, but certainly during at least Tuesday and Wednesday, you may have just positioned yourself at probably, again, one of the best positions on the chart or locations on the chart, evidence during the period of late May into early June. That is the significance of price action respecting an intermediate trend line, because often, all right, it doesn't necessarily have to linger around the trend line, but even if you close below it, the benefit of the doubt, even as at the close on Monday, was still with the buyers, because again, the golden rule of technical trading, as long as you get these trend lines and also extensions of the primary bullish trend, right, the intermediate trend's correct, you're going to understand that over time, the market is going to continue to higher prices up until the point whereby the reversal happens on the market cycle. Now, again, this is, I think, statistically now the longest economic expansion, if not it is soon to be. And that is a very big milestone. A lot of people would never have thought that was going to happen as out or coming out of the depths of 2009, especially during the period 2015 and 2016. And I just wanted to make one particular point. This is not going to be a technical analysis video, the current snapshot of the financial markets. I would encourage you to jump on into that Pivot Point Pro analysis class. Also, for those key pieces of fundamental data, which I do think people should be more so made aware of. All right, I can't do everything for you when it comes to these public YouTube updates, but I just wanted to leave you with a very significant, I think, parallel at this particular time. Again, we're talking about the market structure, and in order to do so, I'm going to just show you this very quick parallel between the period of 15 and 16, because at this particular time, even we ourselves here, we're very, very cautious about the market. But I think it's something that you should be made very well aware of. Up until the point, right, of late 2014 into the beginning of 2015, we continued to rear our head into this resistance area. We failed repeatedly, all right? We saw a couple of decent sell-offs back into the macro primary bullish trend. What happened? We held it. We rallied once again. This period very similar to what we currently find ourselves in as at the high back in January of 2018 to currently even where we are trading at as at the close on Friday. What happened? Ultimately, the trend line held. We got back above it. Slowly, it appeared as though we rolled over until we got a couple of candlesticks here whereby it was looking as though this was going to be the final reversal, or at least the continuation, the significant sell-off. What happened? We turned on a dime after printing a new all-time high. And again, this is looking from this vertical line to the left. Imagine that all of this price action didn't exist and you're just really looking at this little snapshot over here. What happened was, obviously, we reversed out of it. This is on a weekly time frame, and we never looked back. I think that there is a very high probability it won't play out, obviously, identically to what it has done during this period, but I think that there are enough parallels, not only in price action, but also the current mood, and also, you could say, the prevailing sentiment of, unfortunately, the majority at this point, to suggest that something like this, again, is entirely possible, which is going to lead us through to that ultimate parabolic blow off top, which will then set in stone the reversal, which will come not in the year 2019, possibly in the year 2020. Again, it doesn't really give you all that much power. Even as I sit here, I can't sit here in good faith and tell you definitively when that market turn will come, but by all means, we are going to have our finger on the pulse of that. What we need to get through at this particular time, first of all, is to continue to see these markets not only hold their respective most recent pullbacks. This is, of course, as we transitioned into the period of August. Here we are very early on. And I was saying before, even in Pivot Point Pro, if you go to a monthly chart, as bearish as what it has been, we're only 61 points down on the S&P 500 from pretty much an all-time high. Pardon me. On the Dow Jones, we're down just over 500 points. These are percentages or points whereby you've seen the market make back in a single day's worth of trading. What is most important, again, is that we are respecting these upward sloping trend lines. Okay, it's critical. So as we continue, right, or as the market continues to reveal simply what's going on, we want to make a couple of distinctions. Number one, we stay above the intermediate trend line. If we break below it, we want to stay above the swing low in May and June. These are the worst case scenarios that I'm just talking to you with right now, or talking to you about right now. What would be the best case scenario is that we just set up a V bottom and we rally straight out of this. We really don't have any resistance at 26,750, nor do we have any resistance back up towards 27,250. Again, I might change on over to the S&P 500 because this is really the mantelpiece of our analysis when it comes to the US financial markets. But again, likewise, the best piece of, or the best case scenario is that we just simply rally out of this. But as it stands anyway, it's all a period of consolidation whereby we are very close to the legitimate trend of this market higher. It looks as though we were getting there In the period of June and also July prior to this, it looks like, again, very similar to 2015-16, we've overshot it. And I'm posing you the question right now, during that period, as to where the world believed or thought that there was a probability that we were sliding into recession. I'm sure you remember that dicey period. Back in 15-16, I remember it like it was yesterday. I think that this period right here, okay, is very similar to what we went through back then. And I think the conclusion of this is also going to lead to significantly higher prices. One final thing I wanted to point out that I haven't spoken about without going into sort of really in-depth analysis with you is that even as at the close on Tuesday, we were speaking about the idea of an island reversal. An island reversal whereby you get a gap to the downside, you see an immediate handbrake pulled on the market, and then essentially you get a gap in the opposite direction, which creates that of the island. Now, we don't necessarily have it. I mean, we do technically have it. You could see if you zoom in enough on the S&P 500, it is there. So, I mean, the island reversal did occur. And this is a very strong reversal pattern in and of itself, outside of the fact that it's also occurring at a genuine spot where it should. Okay, when you go to the Dow Jones, again, not as nice as the S&P 500. You got the little gap here, but we do have overlapping wicks just here. But for argument's sake, it is very close to actually setting up that of an island reversal as well. You get an extreme sentiment shift, and it happens very quickly. And there is a high probability that we're just setting off that of a very quick short squeeze, which is going to result, maybe even over the next couple of weeks, the market's back up at their all-time highs and shooting above. Okay, so I just wanted to talk about that. Again, I would encourage you to take the time, invest in yourself and learn how to do this, whereby you are not at the whim of your emotions during periods like this, and probably most significantly would be Q4 of 2018. This period here, people were losing their minds. You think about the elation leading into the reversal, right? Up here, we had indicators going off all over the place that essentially we were liquidating trades up here at 8,000, right? Prior to the reversal, a lot of people had their year-to-date returns, if not multi-year returns, pretty much wiped out and back to sort of naught over here. Nor did they step up and actually buy the market off from a logical area of support. So 2019, year to date, here we are in the month of August. Pretty much, people keep talking about how the markets are up, right? Probably now, just under 20%, given, of course, this little correction we've been in. But really, when you think about it, and I continue to say this, the markets themselves, they're pretty much gone nowhere. All right, we've gone up, we've gone down, we've gone up, we've gone down, we've gone up, we've gone down. So over time, and over the period since, again, going back to January 2018, whereby if I show you it on the S&P 500, it becomes a little bit clearer. Essentially, we're just stuck in a rectangle. So here we are, we're flirting with the breakout, pretty much back at naught, as we have been, all the way back in July. And what should excite you is not the fact that the markets are up since December. It's pretty nice, the actual sort of the calendar year return, all right? But it doesn't really mean anything. What will mean something, all right, and the position, or at least when you want to be invested in the market, is already now. It's already passed. I mean, it hasn't technically passed, but this is inevitable, in my opinion. All right, we're going to break up and we're going to trend. And the real returns are going to start once we definitively clear these areas and once we set off definitively in a trend. Again, this might be the final whipsaw the market's throwing out to really sort of scare a lot of people, or to sort of keep people on the sidelines, whereby they'll start jumping in once the market has confirmed the move. All right, but for all sort of argument's sake, there's not much more that the market can do except go through the sort of the natural sort of time of the market and the timings of things, and just the natural progression of the day-to-day sort of candlesticks to unfold, whereby, who knows, maybe by August, maybe by September, but I will say I'd be shocked if it wasn't by the end of 2019. These markets are a lot higher as to where they were in the midpoint of July 2019. And I shared a couple of clues why with people in that class that we just recorded a little bit earlier today. All right, so on that note, everyone, I just wanted to leave you with that weekend analysis. Don't be fearful. Now is not the time to be fearful. The sentiment of the majority is rather fearful. And as such, you should be buying the market. This is not a reversal. It's not a macro reversal. We still have adequate gas for this market to move higher. And for those who are savvy, they continue to buy the market at a discount. All right. And the bears out there sympathize with you. However, you're still wrong. I mean, there's no other way to put it. All right. I understand the arguments for it. And look, you will be right ultimately. But we will flip from bullish to bearish when that time comes. Or at least we'll do our very best to do so once we see certain things unfold. Right? Technical things, right? Structural damage, legitimate reversal signals, but also some of these fundamental metrics that unfortunately not enough people are aware of. So again, I posed the question, what are you reading? Where are you getting your sources from? What metrics are you looking at that tell you fundamentally, apart from people on TV, telling you that it's all doom and gloom? All right, because I don't want you to be the sucker on the wrong side of this market moving higher and missing out on a bunch of tremendous returns that I think are going to filter into accounts that are structured and set up to take advantage of this market in the event it moves higher. Okay. So on that note, thanks a lot for watching this video. I'll see you next week as the market opens, and we'll track it, obviously, a couple of times each week here in this public domain. All the best, everyone. James signing off on behalf of Pivot Point Trading. Farewell.